All right, guys, what's going on? Good afternoon. Welcome aboard to the Fed recap, I guess. We're talking about the macroeconomics today. The reason I'm doing this is because I asked on YouTube, I believe 2 days ago, talking about did you guys want me to go over the Fed and exactly what happened, the price action, what we expect? Most of you guys said yes by typing in Fed in the comment section. So again, if you love these kind of videos, me explaining different things regarding macroeconomics and the market and what these news headlines and reports mean, feel free to comment on this video and type in the word Go GAR Capital. Go GAR Capital. GOGAR CAPITAL. I was afraid that I didn't spell that correctly for a second. So as you know, my name is Carlos Garcia. I'm the founder and CEO of GAR Capital. Happy to be your host today and every single day on our YouTube channel. And if you haven't already, make sure to hit that subscribe button and to join us when we are on. Okay, so today we got a 25 basis point hike. The Dow Jones jumped for the 13th straight day. So last time we've had that was in 1987, October 87. I know, everyone's afraid. So let's go ahead and go over some quick numbers. I'm going to go here to the blog and bring this up here. Quick data on this point. Again, we're now 13 days in a row. So since World War II, there's only been 3 other times that the Dow Jones Industrial Average has jumped 13 sessions in a row. 3 to 6 months later, so we're going to break it down here. Here's the actual scale. The dots are the signal dates. 1970, 1987, and then we also had it back in 2016 or 2017, I believe. So those are the years that we've actually had, and we just had another one. So I want to say this is 2018. This is about, this is around 2016, 2017 or so. Don't have the exact date. So 1970, you can see we did dip about 5 years later. 1987, we had that dip, big dip, the big crash of 87. And in 2017, we just kind of trekked higher, and then we had the 2018 Fed tightening dip. Then we had COVID. Then we had the bear market rally. And again, if you expand this out so wide, it seemed like these dips are so small in comparison. The big dip looking like 2008, as we know, the crash, a little bit more of a dip. And here's your COVID one. Again, big crash, right? In terms of this scale. So we already hit that level, the 13 in a row. And you can see in a 1 month return, on average, we gain about 2.7 more percent 2 out of 3 times, 66% of the time. In a 3 month period, so again, if we're in July, August, September, and October, so again, 3 for 3. So in October, as long by October 26, we gained 6.3% on a 3 month basis. But the 6 month return comes out to 11.6%. That's every time. And in a 12 month basis, 66% of the time we gain 6.6%. So this is a very bullish signal. I don't know how this is a bearish signal. Could we get a dip? Yeah, we talked about that 50-day moving average being a possible level. So what we got today was just a 25 basis point hike, which was very much expected by the Fed. So really the question is, why did we jump? Why did we chop? What was kind of the deal? And some of the headlines that stuck out to me are this. Powell, he said, I don't see inflation back at 2% until 2025. That's when the market kind of chopped around. Powell, quote, said, would stop raising before getting to 2% inflation. So again, he's already saying that he will stop raising even before we get to 2%. Jerome Powell says, don't see inflation back to 2% until 2025. Powell says, not using long-term optimism, but there is, not using the term optimism, and I quote, but there is a path to a soft landing. Couple of other headlines, I believe, in regards to Powell. Powell said that the Federal Reserve staff economists were no longer forecasting a recession this year. So recession is off the table according to the Fed, quote, given the resilience of the economy recently. Those forecasts, which are independent of those produced by Fed policymakers, said as recently as a June meeting showed a, quote, mild recession beginning later this year. So now the tune has changed. June Consumer Price Index report a sharp drop in overall inflation. When asked why that data did not support a decision to hold rates steady, meaning no hikes, Powell said, we're going to be careful about taking too much signal from a single reading. So that's what we got. Looking here at the S&P 500. what does this mean really for the market? I mean, we could talk about the macro, of course, 25 basis point hike. We can talk about interest rates. We'll go to do that rather quickly. Here's the 10-year Treasury yield today after the Powell. So again, if we're getting rates to fall after he's speaking, that's really saying a lot. But we do have a gap to fill here on 3.962. Let's go and take a look at the daily. This will give us the 10-year basis. Again, remember, we broke out of this trend line. We're kind of getting back, and we're below the 20-day. Again, it's just chart work. We still got a big gap to fall here at 3.143. So that's about 700 basis points below where we are now. So what would cause us to get those basis points back down from the yields in terms of the 10-year? We need to have rates stop hiking. Number one, we need to pause. So what's kind of our path to get there? August, there is no Fed hike. There's no Fed meeting, so there's not going to be a hike. The next meeting is in September. So now we have coming up August, which is we'll have the CPI number and their PCE number, PPI and all that good stuff. So far, CPI has been going through the expectations that we have, which is continuing to fall. Remember, July was the peak in terms of inflation. Remember, that was the peak of oil prices. So we're going to get the last base effects of having a big number in terms of the totality of the data that we're using based on a one-year basis. So July of 2022, which we're going to be using as part of our data plot for CPI in August, because we do 1 month behind. So the August report will be July. So July, that will be the last one. Remember that July is the peak. We take that data out when we do the September inflation reading, because we're doing August, that number might skew. So again, we also have had a pop in crude oil. Remember, we talked about crude oil and that bounce. Nothing has really broken out as of yet, except we're above the 200-day. But we know how important gas prices are in terms of consumer sentiment and in terms of inflation, since everything runs on pretty much gasoline and crude oil, which is transportation costs and the like. So we go to gasoline futures. And again, we're getting back to around $2.88, which was the high right around April. So again, we'll see if the dollar does continue to go down. If the dollar continues to go down, gas prices are going to go up in terms of the amount per barrel because they're priced into dollars. The only way we can kind of take away this correlation is if we have increased supply of gasoline. And I don't think OPEC really has a big motivation to want to drill more or want to, produce more oil. So again, we'll get a pop in oil. Again, we expected that because that's really the residual effects of a dollar falling based on the Fed possibly pausing in September. So I do expect in August that inflation continues to settle down because we really got this pop in oil back in mid-July. So the data is going to be a little lagged. So I expect August to get below 3% on a headline CPI number. If we get a 2 point something handle, that's going to probably be good enough for the Fed to pause rate hikes in September. I expect that to happen. If the CPI comes in hotter than expected on our August reading, then we'll probably get one more. The good news is that we don't have a dot plot anymore. We don't have the Fed telling us that this is exactly what we're going to do. This is what we're expecting. That's done with. Now they're on a case-by-case basis. Here's the good news and here's the bad news. The good news is that now the Fed is not stuck in a box. It seems like they're already taking a victory lap that inflation has eased. And as they should. Obviously, nothing has broken. Employment is still pretty much at maximum employment. We had a bank crisis, pretty much averted. The Fed took action. So, so far so good in what they're doing. Stock market is going up, but again, that's inflationary too. So it's kind of a tough way to maneuver if you're a Fed chairman or a Fed governor. So really the idea here watching here is the CPI number in August. So again, if we have a below 3%, a 2 handle, 2.9, 2.8, that's going to probably be enough for the Fed to pause in September. And again, we don't know what they'll do in October. So if you get a pause in September and then we get a spike in inflation and we get another hike in October, October tends to be a little weaker in terms of seasonality, as we know. So that might be setting up for a little bit of a pullback, which is definitely necessary. 13 days in a row in terms of the Dow. That's a lot. So, you got to kind of look at it that way in terms of, kind of pulling back in terms of prices and asset prices. The saying goes, trees don't grow to the sky. So again, I don't expect us to go to all-time highs tomorrow. I think we're going to get consistently higher asset prices, stocks, as the dollar pulls back and as earnings come in better than expected. We also had Meta today, and they beat on earnings. Really good stuff, and they're soaring. So we broke above 314. I'll watch the calls tomorrow and see if we can play it. We got the Fed out of the way. So far, so good. The S&P ended the day flat. Not exactly anything to worry about. We got Boeing today. I'm so glad that we did. That gets us to 19 in a row for GAR Capital in terms of options. 19 in a row. That's Marathon, Block, DraftKings, Caterpillar, DraftKings again, JP Morgan, Metaverse, Shopify, Amazon, PayPal, AMD, Caterpillar again, Palantir, Apple, Goldman Sachs twice, JP Morgan again, Chevron, and Boeing. That's 19 in a row. Congratulations to all of our followers who have traded with us. And if you're counting at home, we're also 22 out of the last 23 in options trades. Entries and exits are all posted on premium signals. Basic members don't get exits, but again, every single trade is posted with analysis and of course, screenshots to follow. So again, I'm very, very happy with the team and the members. Congratulations to all of you guys who are coming with this ride. These kind of rides don't last forever. So eventually, we're going to have a losing trade. Might happen this week. It might not. So all you can do, guys, is just be grateful. Obviously, your skills, all our skills have been working out together. And what we want to do is continue this momentum moving forward. Do not change anything in regards to what you're doing currently. You stick to the plan of what you're doing. You stick to your position size because all of this can change in a heartbeat. So I'm happy about 19. But again, my goal tomorrow is to get to 20, 21, 22, 23, and just keep going, making you guys money as much as I can, as fast as I can. So in regards to the Fed, we're just going to kind of wrap it up here, guys. I think it was all positive. I think that the Fed now is kind of looking at it as a victory lap. To me, I call it a dovish hike. So I do expect asset prices to go higher. Again, pullbacks to me are just opportunities. All-time highs are coming. It's really just based on by when. I said by end of the year. That might be too late. I think that might be sooner. But looking at the S&P and the Dow, the S&P, guys, is really just about 4.4% away from all-time highs. We just had a Fed day. I know we're used to Fed days in 2022 being absolutely terrible and ugly for price action. But even all that being said, even with a price hike, and we had Microsoft be down today. Don't forget, Microsoft was down today. How much? About 3.76%. That thing was down as much as, I believe, 4% today. And look at the names. Tech was not up today. Microsoft, AMD, Netflix, Amazon was down. Palantir, Carvana, so not high betas either. Nvidia was red. Tesla was red. Apple was green today, but for the most part, it was not carried by tech. So if we go back to the, where we're going to go to RSP, equal weight S&P, up another quarter point, about to break out. This is all S&P 500s equally weighted. You can't say it's concentration anymore. We did get concentration on the way up, but we're starting to see more advancers versus decliners. We're starting to see a broadening of the rally. I think we're just really in the beginning stages of something big where we get to all-time highs. We'll get a pullback, an opportunity, and then we'll see if we get continuation, especially if inflation continues to fall and a Fed that also plays ball. Thank you guys for joining me for this video. It was fun to do it. If you have any questions in the future, make sure to comment below. I'll answer them as quick as I can. Thank you guys for being a viewer. We love you guys, and we'll see you guys tomorrow for the morning note. Cheers.